Hey everyone, thank you for whoever will be watching this video. This presentation will be about an investment that me and Shelby ran into of $100,000. Great news. Great news if we're running to $100,000. So we'll be talking, I'll be talking about economic forecasts, the risk tolerance that me and Shelby have, the industries that we think that will be profitable here in the near future, the three stocks that I picked out, and what we plan to do over the 5 to 10 year period, what on average we should be having in returns for each month, for each year, for a 5 to 10 year period. So first I'll start off with the economic forecast here that I thought of. So I'm going to be talking about GDP, unemployment, and then the inflation rate. I think those are obviously three key points for if you want to predict economic forecasts or look into the future. For GDP, I have numbers here from, I think it's Clippinger.com. Our GDP, gross domestic product, is supposed to increase by 2.9% this year compared to 2.3% last year, which is pretty good. That is due to tax cuts and the overall health of the economy. Our current government administration, as much flack as they are getting right now, they have done a good job with the economy and producing great returns for investors. It's a great market to invest in right now. Thing that could halt our GDP growth is the trade war that quote unquote is going on. If that does go south, we could see a drop in our GDP, which we don't want to see. My second point, unemployment. Great statistic I got off Clippinger.com. I thought our short-term unemployment has reached its lowest since 1953. That is the period of the Korean War, and my mom and dad weren't even a thought then. So that's how long that's been. Over 50 to 60 years ago, our unemployment hasn't reached as low as it has today, which is, I looked it up, but this was in May, not June. Our May unemployment was 3.8%, which is extremely low, I think. But you know what? People have jobs and our economy's in a good, healthy position, so what can we complain about? So my third point, inflation rate, which is 2.9%. Inflation rate kind of goes with the economy. The government tries to regulate inflation rate. So it's 2.9% in June. By year's end, Clippinger.com predicted it would be around 2.5%, which, we can see throughout the next about 6 months, we're going to see about the inflation rate drop maybe or rise just a tad. It's going to be around that 2.9 to probably 2.7, 3.1 range, I would say. So our economy looks good. Unless these trade wars are for sure, in serious talks, then our economy might drop a little. But other than that, I think our economy for the next 5 years should be okay. I don't see any major drops. I could be wrong, but we got to look out for the best right now and just plan for the worst, hope for the best. So me and Shelby's risk profile. We averaged a 27 score, which means our risk level is average to moderate. My family, my father is not a big risk taker, a high risk taker with his portfolios that he manages. So I've kind of learned, if you want to invest in a high risk portfolio, you're pretty much writing your own death wish. So me and Shelby, we're going to be conservative with this investment of $100,000 and hope to grow this over a 5 to 10 year period so we can get consistent returns each year, no matter if the number is 4 or 3% each year of our returns. I'm fine. As long as our money's growing at a consistent rate, then we will be fine taking this money out here in the near future. So what we plan to do overall with this $100,000 investment, what's the time horizon? How much money do you want to average per month in growth? How much money do you plan to earn in return a year? We got to ask these important questions. So our time horizon, me and Shelby agreed, around 5 to 10 years. I would say more 5 years, 10 years is a little riskier, but we are young. We're only 21, 22 years old, so we kind of want this to grow a little bit because we can take this money out in our 30s when we really need it and have a great return on our investment and come out happy. So annually, we agreed if we can get a 5% return each year, then I really like our chances. So in order to get a 5% return each year, our money would be at $125,000. So $25,000 over a 5-year period, $50,000 over a 10-year period. So on average, we would probably have to make $420 a month over a 5-year period to meet our goal, which isn't bad. It's not bad at all. I think it's doable if we place our money in good stock portfolios, bond funds, and mutual funds. So we cannot have above a 60% risk, 40% average risk. We need to be the other way around. So industries, my next point, industries of profitability. I chose capital goods, consumer cyclical, and energy. Energy to a point. I think if you look at companies inside the energy industry, I don't think they're quite up to the levels of where investors are going cuckoo over the returns that they are getting. But I think that capital goods, especially companies like I'm going to talk about in Boeing and Lockheed Martin, they're just consistent performers, and that's what we need if we want to have a consistent returns. We need consistent companies. So, and then consumer cyclical, I chose my third stock I'm going to talk about is Netflix. Over the last 10 years, I looked at a graph from Morningstar, and if you had $10,000 10 years ago, invested it in the Netflix, you'd be a millionaire. So Netflix is my third stock. I'm going to talk about Boeing and Lockheed Martin as well. So we get to Boeing. Boeing stock, 10 years, if you had $10,000 and invested it 10 years ago, you would have over, I think it was over about $30,000 to $40,000 right now, which is awesome. If 2008 and 2018, you're getting from a $10,000 investment over $30,000 to $40,000, or $30,000 in profit, $20,000 in profit. That's awesome. Are you kidding me? So we're going to compare the ratios of Boeing to the industry of aerospace and defense. First ratio is PE ratio. We want to have a high PE ratio, which means higher growth rate in the future. So PE ratio for Boeing's 24.82 compared to industry average at 24.9. That's not bad. We would like that Boeing's number to be a little higher, but it's industry average, so we'll take it. Now we move on to current ratio, which means a company's ability to pay off short-term liabilities with assets. Higher is better, better than 1. Not as much risk if it's better than 1. Industry average. So as an industry, there's not much risk investing in this industry. They're able to pay off their assets and everything. They're just a great industry to invest in. Their PEG ratio tells investors what the stock value is relative to the earnings growth. Boeing's PEG ratio, PEG, is 1.36. Under 1 is good value, and then we look at the industry of 2.47 PEG ratio, which is interesting. So according to their industry, Boeing is undervalued. And then in the PowerPoint, it says the 1-month return, 5-year return, 10-year return for Boeing, which is pretty good. They're constantly 1-month return is 8%, 5-year return is 29.21%, which is awesome. Is what we need. If we just had Boeing, put our $100,000 stock into Boeing, $100,000, times 0.2921 plus, so we'd walk out of here with $29,210 in profit if we placed our money into Boeing for 5 years. So we'd walk away with $29,210 in profit. Awesome, we'll take it each day of the year. Next company that I'm looking in for our stock portfolio is Netflix. Once again, their numbers are great compared to their industry average. Right now, their 1 month return is negative, which is odd. I haven't read too much into it. I will, though. That negative 9.09 compared to their industry of negative 0.74, that's a huge difference. But their 5-year and 10-year return blowout industry average. I mean, it's crazy. Whoever invested in a Netflix 15, 20 years ago, 10 years ago, they're making great money now off that investment, to be honest with you. Their current ratios on industry average, but their price to earnings ratio and their PEG ratio are just, their PEG ratio actually, timeout, their PEG ratio is above industry average, which is, I think, is kind of odd. Do you guys think that the Netflix stock is overvalued? I don't think it is. I mean, their 1 month return says it is, but I'm not looking at 1 month return. I'm looking for 5-year, 10-year returns, and their 5-year returns 59.49%, 10-year return 57.05%. Great numbers compared to industry average. I'll take Netflix any day of the year. Last stock that we'll be talking about today before we get to Shelby is Lockheed Martin Corp. That is the same industry as Boeing, so I took this company because their numbers are above industry average, and like I said before, the aerospace and defense industry gives out consistent returns if you choose a good company like Lockheed and Boeing. That's about it. I mean, I think Lockheed, their 5-year returns 24.25% is what we're looking for. So 24.25% 5-year return for Lockheed. Boeing's 5-year return is 29.21, and Netflix's 5-year return is 59.49% 5-year return for Netflix, which is awesome. So we chose 3 stocks that are giving out great returns. The 5 to 10 year basis which is our time horizon. What we're looking at is 5 to 10 years. So I hope you enjoyed it. I'll be passing this along to Shelby. Thank you so much. Have a great rest of your day.